Welcome to Stock Incubator. Today we are breaking down the market question behind this story. Ola Electric has become one of the cleanest India EV stories after the May update. The stock is not moving because of one headline. It is moving because the narrative changed in layers: Q4 results, cash flow improvement, QIP funding, May registrations, ARAI approval, battery cell certification, and now Delhi's EV policy. That is a lot of fuel in 6 weeks. But here is the contrarian hook: a rocket can still crash if execution does not catch up. This video is not a repeat of the mid-May Ola story. This is the update video: what changed, what is real, what is hype, and whether Delhi EV policy is a genuine reset or another execution trap. The timing matters because a May update video was mostly about earnings damage and stabilization. Late June is about whether stabilization is turning into a new catalyst stack. The audience needs to understand this instantly. This is not an old Ola story with a new thumbnail. It is a new chapter after the company reported better margins, raised capital, showed registration recovery, and received fresh policy oxygen.
Ola Electric has become one of the cleanest India EV stories after the May update. The stock is not moving because of one headline. It is moving because the narrative changed in layers: Q4 results, cash flow improvement, QIP funding, May registrations, ARAI approval, battery cell certification, and now Delhi's EV policy. That is a lot of fuel in 6 weeks. But here is the contrarian hook: a rocket can still crash if execution does not catch up. This video is not a repeat of the mid-May Ola story. This is the update video: what changed, what is real, what is hype, and whether Delhi EV policy is a genuine reset or another execution trap. The timing matters because a May update video was mostly about earnings damage and stabilization. Late June is about whether stabilization is turning into a new catalyst stack. The audience needs to understand this instantly. This is not an old Ola story with a new thumbnail. It is a new chapter after the company reported better margins, raised capital, showed registration recovery, and received fresh policy oxygen.
The mainstream headline is simple: Delhi EV policy sends EV stocks higher. The smarter question is harder. Does this policy actually change Ola Electric's business? Or does it only improve the mood around the stock? Think of Ola like a scooter climbing a steep flyover. The policy is the tailwind. The quip is the extra battery. The service turnaround is the repair job. But the scooter still needs traction, deliveries, margins, supply chain discipline, and customer trust. After the prior Ola video, the thesis shifted from survival pressure to execution proof. That is why the title is not just Ola Electric Rally. It is Delhi EV Policy Rocket or Execution Trap. The reason this is strong for retention is that both sides are believable. The bull side has hard updates. The bear side has hard scars. That tension keeps viewers watching because neither answer is obvious.
Over the last 6 weeks, 4 things changed. First, Q4 FY26 made FY26 look like a reset year. Revenue was weak, but gross margin and cash flow discipline improved. Second, May registrations rose to 15,139 units, up 23% month-on-month from April, showing demand was recovering after the service bottleneck period. Third, Ola raised about 780 crore rupees through a QIP, giving the balance sheet more oxygen. Fourth, the policy and technology stack improved. Delhi approved a large EV push. Ola got ARAI approval for a commercial scooter, and its 46,100 LFP cell received BIS certification. The first micro payoff is this: the story is no longer only losses. It is losses versus execution recovery. Each update answers a different investor fear: demand, cash, policy, technology, and service. This is also why the script should move fast. Every section answers one question: did this update improve the business, improve sentiment, or simply delay the next test? Delhi's EV policy is the new headline catalyst. Reports say the policy carries an 15,000 crore rupees outlay over 4 years, targets stronger EV adoption, and supports charging infrastructure and clean mobility. For Ola, The policy matters because Delhi is a high-visibility EV market. It affects two-wheelers, last-mile mobility, fleet operators, and the perception that governments still want to push electric mobility. But policy is not the same as profit. A subsidy can create demand. Charging infrastructure can reduce friction. Registration and tax benefits can help consumers. But Ola still has to convert policy support into bookings, deliveries, service quality, and margins. Policy opens the door. Execution decides who walks through. The risk is that policy excitement can pull demand forward temporarily. The opportunity is that a large city policy can change behavior if consumers, fleet owners, and charging providers all respond together.
Ola's Q4 FY26 results were messy but important. Revenue was 265 crore rupees in Q4 and 2,253 crore rupees for the full year. That is not a victory lap. Q4 revenue was down heavily year-over-year. But gross margin moved to 38.5% in Q4 and 30.6% for FY26. Net loss was still large at 500 crore rupees for Q4 and 2,276 crore rupees for the full year, but Q4 loss narrowed from the prior year. This is the second micro payoff. Ola is trying to prove that lower volume does not have to mean broken economics. The bear case says revenue crashed. The bull case says the cost base and margins finally started behaving. The right interpretation is balance. Viewers should not be allowed to forget the weakness. Revenue pressure is the scar from the reset year. The only reason the story works now is because the margin and cash flow signals changed at the same time.
The most important line in the Q4 update was not only revenue. It was operating cash flow. Ola reported positive operating cash flow of 91 crore rupees in Q4. The auto business alone delivered 213 crore rupees of operating cash flow and 173 crore rupees of free cash flow. That is the number that makes the story sharper. It suggests the core vehicle business can move toward self-sustaining execution if volumes recover and costs stay under control. But one quarter does not make a trend. Think of it like the first clean lap after months of engine trouble. Good sign, but the race is not over. Positive cash flow changes the conversation only if it repeats when deliveries ramp again. The next quarter becomes the proof check. If CFO remains strong while deliveries rise, the market gets a much cleaner story. If CFO flips back sharply negative, the Q4 surprise looks less durable.
Operating expenses fell to 428 Indian rupees crore in Q4 from 844 Indian rupees crore in Q4 FY25. That is a huge reset. Management also pointed toward a further quarterly OPEX target near 350 Indian rupees crore. This matters because Ola's biggest investor problem was not only demand, it was whether growth required unlimited spending. The new pitch is different. Better product economics, lower OPEX, stronger service and higher costs scaling better. But the test is brutal. If volumes return and OPEX stays disciplined, the company can show cost scaling better. If volumes return only because discounts, subsidies and policy excitement pull demand forward, margins may be tested again. This is the cost scaling better test. A leaner cost base is powerful only if the company can scale on top of it without reopening the expense floodgate.
Service was one of Ola's biggest trust problems. The Q4 update says average service turnaround time fell 88%, from roughly 9 days in October 2026 to nearly 1 day by March 2026. Parts pendency reduced 69%. Same-day closures improved sharply. This is not a small detail. In EV two-wheelers, service is not a back-office issue, it is the product. If customers fear repairs, demand slows. If parts do not arrive, brand trust breaks. So the service turnaround is one of the most important post-May updates. The bull case says Ola fixed the bottleneck. The bear case says the market needs more months of proof before declaring the issue solved. This is why service metrics deserve a visual reset in the video. show a red repair backlog turning into a green one-day turnaround board. That is the customer trust story in one image. May registrations were the next proof point. Ola reported 15,139 units in May, up 23% month-on-month from 12,323 in April. It also marked the third straight month of growth. That sounds strong, but the retention question is whether this is a durable recovery or a bounce from a weak base. A recovering registration curve supports management's Q1 FY27 guide of INR 500 to 550 crore revenue on 40,000 to 45,000 deliveries, as highlighted in the user-provided Gemini notes. But guidance has to be earned. If monthly deliveries scale toward the break-even run rate, the stock story gets cleaner. If registrations wobble again, the market may treat May as relief, not a turnaround. The trap is extrapolation. One strong month can restart the narrative, but a true turnaround needs repeated monthly registrations and better conversion into revenue.
The QIP was the balance sheet event. Ola launched the issue with a floor price of 37 rupees and 74 paise per share and raised about 780 crore rupees. This is useful because EV manufacturing, gigafactories, working capital, and battery localization need money. The analogy is simple. The QIP is the extra battery pack for the next climb. It reduces immediate liquidity anxiety. But it also reminds investors that Ola still needs capital to execute the plan. Funding is not automatically bullish or bearish. It depends on what the money buys. If it funds capacity, localization, and cost scaling better, it supports the reset. If the cash only patches repeated losses, the trap risk returns. For institutional viewers, the QIP matters because it shows the company could access capital after a hard year. For retail viewers, it matters because capital has a price and execution must justify it.
The biggest technology update was the BIS certification for Ola's in-house 46100 LFP cell. This matters because Ola's long-term bull case is not only selling scooters. It is controlling more of the EV stack, cells, packs, software, motors, manufacturing, and service. The company has also talked about moving the portfolio toward its own Bharat cells and scaling gigafactory capacity, a point also highlighted in the Gemini notes. Certification does not mean instant better margins. It means regulatory clearance and credibility for deployment. If Ola can localize battery cells at scale, the story becomes less like a scooter retailer and more like an integrated EV platform. That is the upside dream. The cell story should be treated as optionality, not immediate proof. Certification is the passport. Scale manufacturing is the journey. Margin benefit is the destination.
The ARAI homologation for an L1 category commercial scooter adds another angle. Reports describe a 4 kilowatt motor, roughly 70 kilometers per hour top speed, and use cases around delivery, quick commerce, and urban fleets. This is important because B2B customers think differently from retail scooter buyers. They care about uptime, running cost, service speed, charging convenience, and total cost of ownership. If Ola can enter this segment well, policy support in fleet electrification can turn into a steadier demand channel. But the execution bar is high. A fleet customer will not forgive downtime. For B2B, the product is not just the vehicle. The product is uptime. That makes the commercial scooter a perfect if-then catalyst. If fleet trials convert, Ola gets a new demand lane. If uptime fails, the execution trap returns quickly.
Here is the final framework. The bull case, Delhi policy supports demand, registrations recover, QIP improves liquidity, service turnaround holds, cell localization improves margins, and commercial scooters open fleet demand. The bear case, Q4 revenue collapse warns that demand is fragile, losses remain high, QIP creates dilution, service recovery still needs proof, and policy excitement may run ahead of execution. The neutral case, Ola is improving, but the market needs 2 or 3 clean quarters before calling it a turnaround. If the next updates show delivery growth, stable gross margins, lower OPEX, and better service metrics, the reset gets stronger. If not, the rocket becomes an execution trap. This video is for education only and is. And with the exact watchlist, Q1 deliveries, revenue guide, gross margin excluding incentives, service start, parts pendency, QIP cash use, cell deployment, and Delhi policy implementation.